That takes us to our talk of the tape. How much life is left in this overachieving bull run? And will good news on the economy continue to be treated as good for stocks? Let's ask Anastasia Amoroso, iCapital Chief Investment Strategist, joins me here. Good to see you.
Good to see you, Mike.
So this bull market has outraced really pretty much all of the expectations of strategists and everyone from the beginning of the year. It's answered a lot of challenges, whether it's the seasonal weakness we were expecting or, seen as too narrow in the first half. Is all that together encouraging, or is it a reason for caution to wonder if we've maybe gotten ahead of things?
Yeah, I think investors did have some reason for caution to start October. You had a number of outsized moves that had to be digested in the markets, whether I'm talking about the yield spiking or the price of oil spiking, or also there's been quite a bit of resurgence in the dollar. So we had to absorb that. When I look at it, Mike, I think the market has actually managed to absorb that. And for example, the Fed said that we're not likely going to cut 50 basis points for the consecutive meetings, and the markets have now repriced to 25 sequential basis point cuts. So that makes more sense, and that's now reflected in the yield prices. We've also had to account for a little bit better growth, better payrolls, slightly higher inflation, and all of that is now in the rearview mirror, and it's also in the price. So I think what's been a bumpy start to October now sort of gives way to there's a soft landing momentum, and there's not much to get in the way of that.
Yeah, it's been tough to actually look for soft spots in the fundamental story, I suppose, at least in the last little while. You mentioned, the Fed kind of curtailing its promise of how big rate cuts might be. We do want to get to some headlines here by the Fed's Governor Christopher Waller. He's speaking as we speak. The economy is on solid footing, he says, and in fact, his revisions suggest the economy is much stronger than previously thought. So clearly, casting the economy in a positive light. Inflation progress has been uneven, but generally in the direction that the Fed wants to see. Baseline, he calls for reducing policy gradually over the next year. So obviously reducing rates and normalizing policy. I guess maybe not too different from how the markets are set up, but it does reflect this idea that it's a moving target based on the last little run of numbers.
I think we've always known that the Fed is going to react to the data, but it's not bad news that the data is surprising to the upside. And what's really interesting, it's not just the Fed that just now is talking about the economy being on solid footing, but also corporations, and specifically banks, are talking about that. So one of the headlines from Friday, the fact that JP Morgan in its earnings report called this a soft landing, called this a Goldilocks scenario, I think that's what's really breathing new life into the market. And Mike, when you look at Atlanta Fed GDP now, it's tracking 3.2%. That's clearly supportive. And then also the city surprise index, it was actually negative for quite some time.
Sure, a few months,
and the earnings revisions were negative because of this weaker economic data. But we've now flipped into positive territory in terms of economic surprises. And I think one of the things that we may see, if not in this reporting season, but in the months out, is that earnings revisions should start to pick back up again, given how solid the economy is right now.
Yeah, I do think a lot of work on just how much estimates for the third quarter came down. It seems like it's going to be an easy hurdle for results to come in ahead of that. I guess the question is where within the market seems, to still have a little bit of juice left in it, given that we've had not only a run in the indexes, but as I mentioned, the equal-weighted S&P also did some catch-up in the last few months.
Well, on the surface, it's really hard to find those pockets. But I actually, first of all, would look at the artificial intelligence trade and the Max 7 trade. Clearly we've had quite an upside here in the last couple of weeks. But if you look at AI theme performance, there was not much in terms of outperformance in Q3. And in fact, a lot of the stocks are range bound, or maybe they were even down a little bit. So I think after this period of consolidation, what's happened is a lot of earnings growth expectations have actually stayed where they are, or maybe they've even been revised higher for the AI trade, but the multiple have actually declined as a result. And if I look at some of the semiconductor, AI semiconductor multiples, for example, price to earnings adjusted for growth is now below 1. So it's actually one of the cheapest levels that we have seen in years. So I would look there. I would also look to financials. Mike, the earnings season start has been absolutely rock solid for financials. Whether you think about the net income margin that they're expecting to inflect higher in 2025, whether it's loan growth with charge-offs, I think there's so much good progress that's being made by financials.